Because when the business is disciplined and built to endure, it naturally becomes high value. Because hello there, Salim Omar here from Straight Talk CPAs. I'm joined by our senior CFO advisor, Abhi. Abhi, welcome.
Thank you. Hi, Salim. Thank you for having me.
Today we're going to talk about a topic, how banks really evaluate your business and why it matters. And I want to start off by saying something that surprises a lot of business owners that we speak to. Some of the fastest growing companies are the first ones to get declined for financing. And it's not because they are failing, it's not because they are unprofitable, it's because they're unpredictable. Revenue is the most celebrated number in business, but to a bank, it's rarely the most impressive one. And this video and this conversation isn't about borrowing money, it's about structure. Because if your business wouldn't qualify for credit today, even if you never plan to apply, that tells you something important about how it's built. Is it built for momentum or is it built to endure?
What happens is when banks evaluate your company, they are not asking how exciting the business is. They're asking how stable is this business under pressure. They look for things like predictable cash flows, consistent margins, manageable leverage, or let's say healthy coverage ratios.
What does that mean? Healthy coverage ratios.
So one of those would be a debt service coverage ratio. So we define many lenders want to see cash flows covering the debt obligations at least 1.25 times. That's not about ambition, but that's about the discipline of that business or the business owner. Predictability reduces risk, and risk is the only thing financial institutions are trained to manage. But predictability does something else as well. It creates confidence. It strengthens negotiation power. It strengthens the valuation of that business. It strengthens how investors see that business. Growth attracts attention, but predictability earns their trust. There's a difference. Growth and predictability, they are part of the business, but there's a difference on how each thing empowers the business. The trust compounds year after year. Profitability allows you to sleep better at night. It allows you business to withstand pressure without feeling fragile at times.
Hmm.
It gives your company strong legs, the kind that endure downturns, market shifts, and unexpected storms, as you would say.
Yeah.
That's what institutions recognize. They are not funding excitement of the business owner. They are funding endurance.
Interesting. They're not funding excitement, so the business owner is feeling excited about top line. Many times we see that, right? There's excitement with market share and growth, and from a top line standpoint. But banks are looking at endurance. Will this business be around if a major hurricane or a storm hits the business? And many times do. I mean, there's uncertainty. The market downturns, and will this business survive? So let's kind of bring an example to make it practical. Imagine I want to give an example of like imagining revenues dropping, say, 15%, 1 5, and margins tighten slightly. Nothing dramatic, just a normal slowdown. What happens? If the business immediately feels tight, if debt payments become stressful, if cash flow turns reactive, that's not a lending issue. That's more of a business model or a structural signal. Yeah, a business model or a structural thing that the business is not going to sustain that. And banks automatically model downside scenarios, but most owners don't, and they should. Strong enterprises aren't built just to win in strong years. They're built to endure average
Yeah,
ones, and they're built to endure downturns as well. So if your company only works when everything is going right, then it is exposed. And enduring businesses hold its shape under pressure. They don't panic, they don't scramble. It absorbs impact and keeps moving. That's discipline embedded in the structure.
that's the one point. Second is the things that business owners don't really see from that angle. Many smart owners aggressively try to minimize the taxable income. And from a tax point of view, that's absolutely efficient.
And we help a lot of our clients do that, right? We've got a whole different thing on tax planning and tax minimization. Yeah. So what's the trade-off?
Here's the trade-off. If year after year your reported profits look thin, that becomes your financial identity. Lenders, yeah, lenders allow certain add backs to your taxable income, but if your strength only appears after these adjustments, not in the core operations, predictability weakens. So when predictability weakens, opportunity narrows for those lenders or anyone interested in the business. It affects lending, it affects valuation, it affects long-term flexibility. So this isn't about paying more taxes per se. It's about balancing efficiency with durability. Your tax return tells a story, how the business has been doing for the last couple of years. But make sure it reflects discipline. Make sure it reflects endurance. Make sure it reflects a business built to last, not just optimized for this just particular 1 year. Because enduring enterprises create high value over time, not just for this one particular year.
Yeah, yeah, I really like this point. And often if we look at just, narrowly and we look at this 1 year or we look at it from a tax standpoint and you feel good that, wow, I minimize taxes. But on the other side, you want to kind of look at the flip side of how, as you shared. Another misconception is that rapid growth automatically makes a business stronger. Not necessarily. If growth comes with shrinking margins, stacked leverage, or unstable cash flow, financial institutions see volatility. They don't see momentum, even though the top line's increasing, but at what cost? So underwriters, they aren't impressed by upside. They're modeling downside. If revenue slows, does the structure hold? If expenses rise, is coverage still healthy? So disciplined businesses, they're designed for, they're looking at the longer term. They're looking at endurance first, expansion second, right? Endurance is first, and then expansion follows that because growth without structure increases fragility. It makes the business fragile. But growth layered onto discipline increases the enterprise value. That's the difference.
So the takeaway from all this conversation isn't how to get a loan approved. It's understanding how serious financial institutions evaluate whether a business is built to endure or built to last. When you start thinking this way, three things shift. One, you design the business for resilience, not just for growth. You second thing, you negotiate from strength because your numbers inspire confidence. And lastly, you create optionality, access to capital, partnerships, expansion. Access to capital isn't about how confident you feel about your business. It's about how confident your structures makes someone else feel.
Yeah, I love that. Banks don't fund ambition, they fund discipline. Disciplined businesses endure downturns. They affect stronger partners, They command stronger valuations. They move faster when opportunities appear. That's a real advantage. Not approval, but how the business is positioned. Because when the business is disciplined and built to endure, it naturally becomes high value. And Abhi, final point, high value businesses, high value enterprises, they don't just grow, they last. And that's the key thing is they last for a while. Really enjoyed this episode. And folks, if you enjoyed it as well, feel please like it, subscribe to it, or place a comment. I make sure that I read every comment that comes. So I would love to hear from you. Thanks, Abhi, for joining me on this video.
Thank you, Salim.